So if we readjust the factors that can be controlled by the Fed, okay, we find, according to Rothbard, the following. The in contradiction of what Timberlake's telling us here, that the Fed was deflationary or trying to be deflationary during the 1920s, Rothbard points out that the Fed increased controlled reserves, the reserves they could control, by 18% per year. So the Fed was attempting to inflate the money supply during this period. Okay? Which brings us to the 1930s. It was claimed by Timberlake that there was an intention on the part of the Fed to deflate the money supply. Okay? And its intention is reflected, according to him, by what is happening, the rate at which the net Fed is changing. And he claimed that the Fed was, let's see, oh, before I actually get to that, I did want to make one more point. Timberlake makes the point that the Fed wanted to help Great Britain. Great Britain was losing gold. It went back onto the gold standard at an overvalued par. Okay? It had inflated greatly during World War I to pay for World War I, to finance the war, and therefore had increased the money supply and prices. What it tried to do to reestablish its position as the financial center of Europe and of the industrial world, it tried to go back onto the gold standard at the pre-war par. Okay. Now, that meant that in order to do that, it had to reduce prices by at least 10% or so. Because otherwise, prices would be very high in terms of gold in the rest of the world. Particularly the coal unions in Great Britain would not take wage cuts. So it was very difficult to deflate the money supply in Great Britain. So the president of the Bank of England asked the President Strong of the New York Federal Reserve Bank to help Great Britain. Okay, now the New York Federal Reserve Bank was the most powerful bank in the system at the time. Okay, and so there was an agreement that the U.S. would change its monetary policy in a way that would stop Britain from losing gold. Okay, why would Britain lose gold at such by going back on to the gold standard at an overvalued par? Precisely because its prices were so high relative to the rest of the world that its exports were low or were falling, and its imports were high. So it had a balance of payments deficit and was losing gold. Okay. So the U.S. wanted to help Britain reverse that loss of gold. So what did the U.S. do? Okay. Somehow Timberlake thinks that the Fed deflated to help Great Britain, but it's the opposite. Theoretically, the way you help a country that's losing gold is to raise your own prices, so that relative to their prices. So that cuts down on imports from the United States, and it increases exports from Britain to the United States as our prices go up. And if that was the Fed's intention, and in fact, it operated on controlled reserves to bring about that intention. Okay. And you know, it's Timberlake himself who's contradicting himself by saying the Fed wanted to help Great Britain, wanted to stem its balance of payments deficit, but intentionally deflated or tried to deflate during the 1920s. Well, that wasn't the case at all. Okay? It did want to help Great Britain, correct, but in fact it inflated. Okay? That was its intention. Another monetarist named Kenneth Weyer, who actually wrote a pretty good book on monetary and fiscal policy, he wrote the following. He says, Great Britain was calling for help in 1924, and Benjamin Strong, president of the New York Fed, heard the call. Expansionary monetary policy in the U.S. would drive prices up and interest rates down in this country so that money would flow into Great Britain in search of higher interest rates, which would tend to send gold flowing towards Great Britain where prices were lower and interest rates were higher. These changes would help Americans' ally build up the gold stock. There can be no question that the Fed would not have moved when it did were it not for concern of the gold standard and the plight of Great Britain. By 1927, the stagnant British economy needed help from the United States and the rest of Europe. Just as had been the case in 1924, monetary policy was shifted to an expansionary program in order to aid Great Britain's struggles to return to the gold standard, unquote. Okay? And that's by a monetarist. Okay. So, Rothbard's reinterpretation of the monetary data and what the Fed could and could not control really also cuts against Timberlake's claim that the Fed, quote, monetarily starved the country into the worst economic crisis it has ever experienced. Okay, that's Timberlake's quote. Okay, on the contrary, if we look at the factors that were controlled by the Fed, okay, they continue to exercise a really highly inflationary impact on bank reserves and the money supply. From 1929 to 1932, this is precisely the period during which Friedman and Schwartz claimed that there was a great contraction of the money supply that was caused by the Fed. Yes, there was a contraction of the money supply, but it was not caused by the Fed, as I'll show you. It was caused by uncontrolled factors. It was caused by people pulling their currency out of the banks because they were fearful the banks would collapse and their savings accounts and checking accounts would disappear. It was caused by foreigners taking their investments out of the country and therefore causing gold to flow out of the country. It was caused by the banks themselves increasing their excess reserves, that is, not lending out money when they could have, okay? Instead, holding the money rather than lending it out at interest because they were fearful that the lenders would default because of the Depression. So if we look at some of the statistics here, we'll see what Rothbard was talking about. Okay? Just keep in mind that there was a loss of confidence during this period in the Fed-dominated, phony gold standard, okay, both by the public and by foreign investors. Right? So, as I said, we had a decrease in currency. We had an increase in currency in circulation. Reserves were taken out of the bank. People cashed in their checking accounts, withdrew money from their savings accounts, and so on. And so the banks lost reserves, and they had to reduce the money supply. And as I said, foreign investors took their money out of the country and cashed in dollars for gold and took that out of the country. So the gold stock declined. And that also caused a decline in the money supply. Okay. And finally, banks increased their liquid reserves and stopped lending the maximum that they could have under regulations. So let's look at the statistics. From the end of 1929 to the end of December 1929 to the end of December 1931, bank reserves fell from $2.36 billion to $1.96 billion, okay, causing Rothbard's money supply to drop. So the money supply dropped in those years from about $73.52 billion, okay, 1929, and this is in billions, to, by 1931, $68.25 billion. Okay. So that was end of 1931. And then it also dropped in 1932 and 1933. During 1932, it continued to decline. It fell to 64.72. And it fell by another $3 billion in 1933, so it was down to 61.72. Okay, so Rothbard agrees with the monetarists. Okay, there was a collapse in the money supply. Where he disagrees with Timberlake and the monetarists was the causes of this collapse. And it's quite a collapse, quite a decrease in the money supply. Okay. What he points out is that the Fed furiously inflated controlled reserves. In the last 10 months of the year, controlled reserves rose by over $1 billion, or 76%. That is, in 1933, they increased reserves by 76% in the banking system. Okay. Actually, that was 1932. The story was the same in 1933. They increased control reserves by $785 million in 1 month alone. Okay, But this was defeated by the public and the banks. Okay, and as I said, the money supply decreased by $3 billion. Now, let me see if I have overall figures here in terms of percent. The Fed increased control reserves by 17% from 1929 to 1931. Okay. So you had that increase by 17%. And as I said, in 32 and 33, they continued to increase the amount of reserves in the system that they could control. Now, what defeated that? If you go back to this, this equation, okay, the Fed's controlled reserves, even though the Fed was increasing the part of the monetary base that it could control through open market operations, banks were paying back their borrowings from the Fed because they didn't want to loan them out. Interest rates were very low. The borrowers didn't have good credit. So bank reserves were falling for that reason. People were withdrawing currency from the banking system, decreasing their reserves more. And foreigners were taking their investments out of the country, and in order to do that, you had to cash in your dollars for gold. So it was not the Fed that engineered this massive deflation. It was a phony gold standard that was breaking down, that the public had lost confidence in. And that's why the people were simply reclaiming their property, both foreigners and American citizens. They were reclaiming their property from a fractional reserve system that couldn't pay off. Okay. Now let me just talk about Timberlake's two other points. Okay. And this is where he criticizes both the Treasury policy and the Fed policy. Okay, the first criticism is the policy that the Treasury followed of neutralizing or sterilizing the effect of the inflow of gold on bank reserves from late 1936 to 1938. So in other words, when gold flowed into the U.S. during this period, during those 2 years, instead of issuing dollars, okay, as those or bank reserves on the basis of gold, okay, the Feds sterilized the gold inflow, which meant that as they bought the gold that came into the country, they sold government securities to the same extent. So there was no net effect on the money supply. Now, why would they do that? Okay, the reason why they did that was because, in fact, we weren't even on a gold standard from 1936 to 1938. What had happened was that in 1934, the Roosevelt administration had devalued the dollar. That is, it raised the price of gold from $20.67 to $35, meaning it devalued the dollar by 60% in terms of the amount of gold it contained. It now contained only 1/35 of an ounce of gold instead of 1/20 of an ounce of gold. So the price of gold suddenly jumped up in the United States to $35. Well, foreigners aren't stupid. What they did was then they began to send gold to the United States in exchange for this higher price, because this was the highest price of gold at the time. So gold did flow into the United States, but this was no longer money. American citizens weren't allowed to own gold from 1933 onward.